Hello, John. How are you?
Good, thank you.
Thank you for your time. John, how do you evaluate the last Fed FOMC decision, regardless if it was in line with what Fed futures were discounting before the meeting? What are the key points to highlight from the statement and the press conference Powell gave post-meeting?
Sure. First, thanks for having me, and hopefully I can enlighten you with some of the aftermath of the Fed's decision. First and foremost, the 75 bip move was not really a surprise. What was a surprise was how quickly the Fed moved from really a firm stance of 50 to 75, and it was leaked to the Wall Street Journal. What's interesting, and I think what undermines the Fed's credibility here is the fact that this was in a what they call a blackout period. So generally speaking, a week before an FOMC meeting, it's by rule that no Fed members can talk to the press, and yet this was leaked to the Wall Street Journal. So in some respects, I feel like this was a quick decision. They wanted to keep markets, basically in tune with what they were thinking, but at the same time, I think this is a bit unprofessional the way they carried this out. Um, Regardless of what the Fed funds were discounting, I think initially um, uh, Powell mentioned in the course of the interview afterwards or the discussion with the press that 75 basis points was actually not the norm going forward, but something of an outlier move, and that they would be more prone to moving 50. And that's in fact why you had a rapid move both in the curve and in the market, where the front end of the market actually rallied almost 25 basis points and the curve steepened almost 20. Um, Now, what I would argue here is I wouldn't necessarily keep or say that Powell's words should be taken literally. And the reason why is he mentioned something else, which I think is very, very important for you as investors to keep in mind, that they were not going to be addressing core inflation, but more importantly, headline. And what I'd argue here is that regardless of funds are at, terminal funds get to three and a quarter, three and a half, four, it's going to be very difficult for central banks, not just the Fed, but central banks globally, to tame, if you will, food and fuel inflation. And if that's going to be the case, it's going to be meaning, or it will mean, that the Fed will have to tighten further than the market expects going forward. Um, I think the key here was, as I mentioned in the post meeting, the key was the fact that Powell said they would be addressing headline, not core, and I think that the market didn't necessarily understand that concept. And going forward, I suspect that as we continue to see very, very strong CPI numbers, particularly headline numbers, this is going to get to the market in more of a position that the Fed's going to have to move more aggressively. And why do I feel that inflation numbers going forward are going to be very, very high? One, you see still elevated rents and home prices. And the reason why I mention this, that's 27% of CPI. Uh, Basically your owner's equivalent rent. And the second point is, I think we'd all agree in this call, there's been no relief, if you will, on global oil prices. If anything, one would argue that with China coming back online post-COVID issues, there's going to be further demand for global oil. So that tightness is going to remain. Food prices, of course, are being influenced what's going on in Ukraine. We don't see any kind of end to that conflict in the next few months. So again, that will push, we would think, commodity prices higher still.
Okay, and then Fed officials project that interest rates will rise to a median of 3.4% by year end. That is basically 175 basis point of additional tightening. In your view, how feasible is it the Fed could reach this base scenario? And what about the neutral terminal interest rate? Today, there's a huge gap between the forward rates and the longer term ones.
Yeah, let's answer the last question first. First of all, what got the market, what encouraged the market at least, was pre-meeting the gap between the forward dots and terminal rate was much greater. Now that difference is only 25 basis points. However, I would argue that if you're running a headline inflation rate of 8, and let's just argue that for sake that supply chain disruptions begin to alleviate, if we still have inflation settling down to the 4.5%, 5% level, a terminal rate of 3.4% is still too low. And Powell actually addressed that a bit. He mentioned the fact that if you look at real interest rates in the front end of the market, they're still negative. Obviously, 10-year real interest rates have gone positive. They're about positive 60 basis points, 70 basis points. They were negative 80. But at negative real interest rates in the front end, it's still stimulative. So I think the Fed has more work to be done rather than just getting to 3.4, unless we see a real tail off in inflation. Now, on the other hand, it's pretty clear that the Fed's going to have a very, very difficult time engineering what they call a soft landing. You're starting to see already weaker data, whether it's consumer confidence, whether it's been home sales, which were very, very weak. Clearly, higher interest rates are putting a dent into spending, no doubt. And if, in fact, one would argue for the marginal consumer, if you have the choice between paying higher fuel and food prices and buying or taking a vacation, clearly you have to put food on the table. You have to put gas in your car. You're going to defer the spending. They do what we call discretionary spending. So, without a doubt, the economy is going to slow. At the same time, the labor market still remains robust, and unfortunately, inflation remains high. Remember, the Fed has a dual mandate. They have a target of 2% inflation, and they have a mandate of keeping unemployment at a low level, full employment, they call it. They don't really have a mandate to keep the economy growing. Of course, they want to, but if it's between the economy contracting and inflation being higher, they'll continue to raise rates. The other question is, how feasible, in your view, would the Fed reach this base scenario? As I said, I think they are going to have to reach 3, 4, maybe even higher, as I mentioned. Right now, the market's thinking that the Fed might move at the July meeting 75 and then stop at a 50. If we continue to see hot or robust inflation, again, I would argue that they may have to continue on the path of 75.
Okay, let me follow up with the economy. What is your view, the view you currently have on the economy, and how does that compares with the statement that Mr. Powell said in the central bank can achieve a soft landing? And by soft landing, I mean controlling inflation without inducing a recession.
It's going to be extremely difficult. You know, one thing we always have talked about on these calls is the fact that interest rates are a blunt instrument with regard to controlling inflation, the economy, et cetera. And you really, you know, the lag effect, just like the lag effect of inflation, the lag effect of higher interest rates is 6 to 9 months. And on top of that, what's confusing the Fed in terms of forecasts and making a market very volatile is the fact that we have a roll-off going on now with regard to QE, meaning the Fed is no longer reinvesting maturing instruments and interest. So effectively, that is another tool that is effectively contracting the economy, taking liquidity out. So they don't know. And why I think that risk assets in general, for example, equity markets are going to be volatile for the foreseeable future is for the first time in 10 years, and this is a very important point, we don't have forward guidance. The markets took comfort in the fact, either under the Bernanke regime, under the Yellen regime, and even under Powell initially in his first term as Fed governor, or Fed chair, excuse me, that they felt very confident that they'd have to either cut or raise interest rates in a very measured way. And that's the key, measured. Now we're in uncharted waters. Think of it this way. It was only 6 months ago that most Wall Street houses, for example, Morgan Stanley, thought the Fed would only tighten 3 times, 25 pips each time for the 2022 calendar year. Now look where we are. So things have changed remarkably. It's clear that the Fed doesn't have a clear picture about where the economy is going and where inflation is headed. And undermining a little bit of their credibility is the fact that they were dead wrong on this whole idea, or the narrative, if you will, of transitory inflation. inflation is lasting longer than they even anticipated. So you have some of the greatest minds in the world sitting at the New York Fed, economists that is, and they were not able to forecast this. So that's why I think markets remain very volatile and will continue to do so. We're in uncharted waters, and I think this is part of the reason why you're seeing equities being so volatile. I mean, yesterday, for example, we had a massive rally in Nasdaq, and today it's all
Mhm.
gone. Markets are reacting in a very erratic fashion, very emotional, and part of this, I think, has to do with the fact that they understand that the Fed doesn't have a clear picture, and that picture remains uncertain. And again, I think the odds of a soft landing are very, very slim, unfortunately. And you're starting to see that. And again, I go back to the point: we don't have forward guidance, and effectively, we're in a position where we don't know how long inflation will be here for. It's just a very remember the last time we were in a situation like this was almost 40 years ago. We've really been in a modern day bull market for 40 years, which frankly has coincided with a bull equity market that may be over.
Yeah, that's right. And so far this year, beyond commodities, there hasn't been any place to hide. So going back to fixed income, uh, where, if any, do you see the best opportunity to invest right now? Rates, duration, MBS grade, if any. And what is the advice you can give to an investor to navigate this turbulent scenario?
Sure. I mean, again, even the greatest minds in finance have been wrong. I recall it was only 6 to 9 months ago that you would see Ray Dalio on CNBC, who runs Bridgewater, the largest hedge fund in the world, saying cash is trash. And then, of course, other pundits were on CNBC saying that the only place they were investing was in equities because that was the only place to go. How quickly things change. I would argue that you still need to be quite defensive. Probably the commodity complex will be relatively well bid for a fair period of time. And I bring this up because this whole nature of going to renewable energy, frankly, you have to have a bridge to renewable energy. And you just can't quickly turn off uh, gas powered power plants or even, for that matter, oil. We need that to get to the next stage, which is going to take years. So I think the commodity complex will probably remain relatively robust. And then in terms of where do I think we should be in fixed income, I think it's a very, very difficult. I think you need to be defensive, frankly, in the front end of the market. MBS, the issue there is even though there are very, very wide spreads, the problem there is it's always under the specter that the Fed could potentially begin to sell in the secondary market, which would put very big pressure on mortgages, despite being at extremely wide levels. I think credit at some point will be attractive, particularly high grade credit, investment grade that is. Of course, there's going to be a lot of companies who suffer going forward because of a slow economy and higher inflation, but at the same time, there will be companies that do benefit. And so, without a doubt, there is pricing power, especially in the consumer durable sector and the consumer discretionary sector, which, there are basic items that people need to buy. So at some point, credit of those names probably should outperform. But in fact, I do think interest rates probably in the long haul will be going higher. And I think you probably need to be defensive in that respect.
Perfect, John. As always, very, very good opportunity to talk with you. Thank you again, and
My pleasure.
bye.
Thank you so much.